Welcome to 3.4 of the IB Business and Management course. Today we're looking at budgeting. I'm Mr. Burden, site author of ibbusinessandmanagement.com, where I hope you're watching this video embedded. There's a whole lot more than this video. Lots more resources to get you going, to get you focused, to get you knowing everything you need to know to achieve full marks in budgeting. Okay, so today, no messing around. 3.4 budgeting in the IB Business and Management course. Let's get going. This is a short topic, not too much to learn, and it's all high level. Everything here is for you high level students. Right, budgeting, what is it? We have a definition here: a financial plan for expected revenue and expenditure for an organization or just a single department within an organization, and we need to specify for which period of time we'll be setting it for. So a financial plan, that's key. We'll be looking at revenue coming in, expenditure going out, and that can be for a whole organization, a whole firm, or just a single department within an organization, and typically for a year. We've got different types of budgets. We've got sales budgets, staffing budgets, etc., etc. Let's run into these quickly right now. The sales budget. Now this is, we are focusing on the forecasting of how many products a business aims to sell over the next year and the likely revenue to be received from these sales. So in other words, sales budgets are a breakdown of the planned volume and value of sales. Staffing. Now this financial plan translates to the monetary costs of staff that are required throughout the organization for the next 12 months. It's going to set a limit in terms of the number of staff and the overall cost of labor. Production budget. This is simply a plan for the level of output over the next year, including forecasts for the level and cost of stocks that need to be purchased. Overhead costs that the business will incur in the forthcoming year will also feature in a production budget. Now the production budget can then be used to help plan and manage capacity utilization in the organization. And if you want to find out more about capacity utilization, we're going to hit that in our 5.7 unit. Marketing budget. Now this is simply the forecast of how a business intends to achieve its budgeted sales through any and all marketing activities. So we're talking about the amount of plan for advertising, sales, promotion, expenditure, etc., etc. Zero budgeting is quite interesting. Now this method sets each budget holder's accounts to zero. So woe to go at the start, the budget holder says, right, what do we need? Where a budget's at zero, what do we need now for the time period? So the head of a division perhaps then has to go and justify the money that they apply for. So there's going to need to be prior approval for any planned expenditure. Your budget is set at zero. You need to be able to justify any expenditure coming from your division or your department. Now, zero budgeting helps the organization to identify areas or departments that require large amounts of essential capital expenditure and those that may require smaller or minimal expenditure. The disadvantage of zero budgeting is it does involve a lot of management and administrative time in comparison to other types of budgets. A flexible budget. Now, this type of budget enables a business to adapt to changes in the business environment. Rapid and sudden unexpected changes are going to result in actual outcomes being very different from the budgeted outcomes. For example, flexible budgets allow production and sales budgets to change according to sudden changes in the level of customer demand. Customer demand starts going through the roof. The production needs to ramp up the amount of goods they're producing. That's going to cost more money. That department is going to need more money to operate to meet that increased level of customer demand. Now in practice, whichever type of budget is used within an organization These budgets are consolidated into the overall budget, and we'll call this the master budget. There are a few different names for it. We think about it as a consolidated, the overall budget, but I'm going to refer to it as a master budget, and that's fine. That's probably what you should be doing as well. The Chief Financial Officer, the CFO, will have a general control and management of the master budget, including financial plans for capital expenditure on fixed assets that the firm intends to purchase over the next accounting year.
Show me.
Why do we budget? What are the reasons behind budgeting? Planning and guidance is a very, very important area. Now, a budget is going to inform managers whether they are going in the right direction financially. All businesses have organisational objectives, and if they don't, shame on them, because they're so important. Budgeting is going to help to measure the progress made towards achieving those targets. Sales targeting $100,000 worth of revenue coming in the month of January. Budgeting is going to help to measure the progress towards achieving these sorts of targets. Budgeting requires managers to plan for the future and to anticipate financial problems before they arise. So this should therefore help the organisation to be better prepared to overcome such problems should they arise. Coordination, another important reason to have a good budget process in place. Now, coordination, a budget is going to enable managers to control the firm's money instead of the money controlling the organisation. It enables managers to control the firm's money instead of money dictating the direction of the organisation. So effective budgeting requires managers to match budget allocations, how much each department gets, how much is given to each division, with the aims of the organisation. A budget helps the entire workforce to focus on common goals, and without the proper budgetary control, budget holders might make decisions that conflict with those made in other departments. Let's just clarify that with an example. So the marketing department might budget to boost sales unknowingly beyond the productive capacity of the business. Marketing says, well, we need a budget, we need these sales to come through, and if they don't know, if it's not coordinated between departments and they actually drive up the level of demand and pass the capacity of the business to produce those goods and services, there's going to be a mismatch. Customers are going to be left wanting. And likewise, the production department might budget to expand beyond the financial means of the organisation. So coordinated and controlled budgeting leads to consistent and complementary actions being taken by different budget holders. Control, quite important. Just as a person cannot continually live beyond their means, I cannot keep continuing to spend more than I earn. Budgeting helps to control businesses' expenditure to prevent liquidity problems. It keeps a rein on expenditure. People, departments, divisions don't have an unlimited supply of finance available to them. It helps them make important decisions. Now, many businesses do not have proper cost control and therefore end up overspending. Without budgeting, managers are not held accountable for their actions. So I'll say that again, that's an important key point, and you want to get it associated with this control reason. Without budgeting, managers are not held accountable for their actions, and this can subsequently lead to all sorts of financial and cash flow problems. In a nutshell, budgets are used to keep, for this control reason, budgets are used to keep better financial control of an organisation. Budget holders are constrained in what they can do, and they're held accountable for their actions. Budgetary control and variance analysis, which we'll get into soon, help to identify areas where a department is perhaps overspending. And by having tighter control of their finances, managers can help to prevent a business going into debt. And this is especially important in those large organisations that delegate budgets to their middle and senior managers. And last, we'll touch on the motivational aspects of budgeting. Now, according to a whole lot of motivational theorists, you would have touched on these in the Human Resource Management section of the course, Unit 2, HRM. Now, the motivational theorists mentioned in that section, for example, we've got Mayo, we've got Hertzberg, a couple of the famous ones there. Now, according to these motivational theorists, recognition, responsibility, and employee participation can be used to motivate. Delegating budgetary control to budget holders can therefore boost their level of morale, since they're going to feel valued and trusted by the organisation. And additionally, involving staff in the budgeting process helps to promote teamworking and employer-employee relations. So this is all an example of non-financial motivation, even though we're talking about it in the accounts and finance section. It's people getting together, it's working out what they need, what they're targeting, coming to an agreement, and that sort of teamworking is very, very valuable, driving forward a nicely motivated team within an organisation. And this is all going to lead to benefits such as being more productive and having your employees away less, so reduced absenteeism. So for the business, budgetary control can act as a method of allocating and clarifying responsibilities in the organisation. More senior managers will be placed in charge of larger budgets. It can also be linked to performance management, just as mentioned above, in order to recognise and reward the achievement of organisational objectives. If you're meeting your targets set out in the budgets, we'll know when to reward or recognise these achievements from a business's point of view. And this can be a further source of motivation, thereby possibly giving the business a competitive advantage over its rivals. That all-important competitive advantage.
Show me.
Let's examine the different ways to set budgets now. So there are a few, we're going to touch on 5 of these. And the first being available finance, which is probably the most important, right? How much finance do we have available to us? How much can each department we allocate to each department? What are they going to use it for? So it's an obvious one, since the greater the financial strength of a business, the greater amount of funds that is available. You've got a strong, well-financed business, it's likely you're going to have a strong, well-financed, well-resourced marketing department, etc., etc. So this will affect the amount of budgeted expenditure for each budget holder. Historical data. Now, budgets are often based on what happens in the past. If $50,000 was allocated to our accounts and finance department for the running and management of that particular department, then it's likely that next year, without any significant changes, is going to be asking for about the same amount. It's going to be allocated about the same amount. So budgets are often based on what has happened in the past, e.g. last year's budgeted figures. Now, if economic forecasts are positive, then budgets may be set at a certain percentage above last year's figures. Second in importance, probably, organisational objectives. This should always be in the background, driving what is going on in other parts of the business, including budget setting. So if a business is planning external growth, then budgets are going to need to be raised accordingly, since the marketing and production budgets will need to be set at a significantly higher level. We have got benchmarking, and this means setting a firm's budget based on the budgets of its nearest competitors. So if Cadbury's budgets for a $2 million marketing campaign, rival firms Nestle and Mars are likely to follow in the same direction. And last but certainly not least, negotiations. Some budgets are set by discussions between budget holders and the senior managers in charge of the master budget. There are a few limitations of budgeting that we need to know. Important for any of those evaluate type questions that come your way in the IB Business and Management exam.
Show me.
Limitations of budgeting. We've got so many here. You typically don't have to explain them. Unforeseen changes. They're only an estimation. No incentives to underspend. Now that's an important one. Often if a department has not spent its allocated budget, they won't be allowed to carry that forward into the following year. So this means that any surplus is simply discounted in the subsequent budget. And this sort of practice gives no incentive for budget holders to come in under budget. It's just going to put pressure on the department and the resources from this management perspective in the following year. Top-down approach, what are we talking about there? In many organisations, budgets are set by senior managers who have no direct involvement in the running of the department. Now that can cause a little bit of resentment, some discontent, since the senior manager may not fully understand the needs of the department. Ideally, the senior managers and budget holders should discuss and set the budget together. And although in reality this only happens to some extent. Now if you go onto the website ibbusinessandmanagement.com, there's a great little infographic there running you through exactly how a well-run organisation typically sets their budgets. So get in there, have a look, and study that a little bit. Now, rigid and poorly allocated budgets can result in lower quality. For example, a lower production budget might lead to the use of substandard raw materials and components being used. Lower quality output will affect sales and probably damage the reputation of the business. Cutting the staffing budget can lead to pay cuts and job losses, and this can create poor morale, poor industrial relations for an organisation. You see links here between motivation and budgeting. The finance is quite an important part of budgeting, and motivation and finance is quite an important part in motivation. What else have we got? We've got the process of planning, setting, controlling, monitoring and reviewing budgets can be extremely time consuming. As the head of Department of Commerce at my present school, I know exactly what they're talking about there. It's not easy to plan, set, monitor and make sure things are going to plan, and then reviewing the budgets after the present financial year. This takes time. Finances are limited, so if one department, one division gains, it's often at another person's loss. So a little bit of a zero-sum game here. If the marketing department wins an allocated increase, where is the business going to find that extra money? They may well take it away from accounts and finance and fire a poor little accountant. So budget holders are going to be essentially increasing, competing to increase their own budgets at the expense of their colleagues. So budgeting can limit the degree of staff cooperation within an organisation. Budgeting often ignores the qualitative factors that affect the financial performance of an organisation. By placing too much emphasis on budgetary control, businesses are going to end up neglecting, or perhaps may end up neglecting, non-financial issues such as corporate social responsibilities, responsibilities towards the natural environment, non-financial motivation of staff, customer relations management, and brand development. All very, very important things, but qualitative, hard to measure, hard to put numbers on. And finally, we'll just discuss this briefly. Critics of budgeting argue that the process is often far too inflexible in today's fast-paced and constantly changing business environment. They therefore believe that budgeting is an inappropriate management tool. So we just looked at what budgeting is, how we do it, why we do it, what are the limitations. Now we come to the second part of the section in 3.4, and that's variance analysis. Variance analysis, an important part. Again, it's just a calculation construct type technique, nothing too much to it. Okay, what is it? If there's a difference between the actual and budgeted outcome, we have a variance. So if we forecast and budget for 100,000 in sales from one department and we come in with $120,000 in sales, brilliant. It's the actual outcome is different from that which we budgeted for. There's variation, therefore we call it a variance. And if we do have a variance, then managers can get in there and investigate. So if the marketing department overspends, the managers can go away and investigate. Why did the marketing department spend so much more in the third quarter than they did in the second and first quarters? Why are they so out of whack with their budgeted allocation? The sales revenue went through the roof in July. Why did it do this? Right. Any variance is arising for something unexpected. Something unusual is happening, and managers can get in there and investigate, take advantage of it, or quickly pounce on any threat that's being posed. So here we have variance defined in accounting terms. So it's an actual outcome less the budgeted outcome. Actual outcome, 120,000 in sales coming through. We budgeted for 100,000 sales coming through. We have a variance of $20,000. An example here, the marketing department was allocated 20,000 in July. They spent 26,000. What is the variance? Now we can do this in three ways, and we might be asked to do it in all three ways in the business and management exam. So we can put a dollar figure on it. Obviously 6,000, overspent by 6,000. We can turn that into a percentage. We spent $6,000 more than our allocated 20,000. Please don't ask me to do the maths there. It's a little over a third. So as a percentage, something more, probably about 38%. It could even be close to 40%. About 40% over budget. And we always talk about budget variances being favourable or adverse. In this case, they've overspent. The marketing department, shame on you, has overspent by $6,000, and it's quite a lot, 40%, and it's an adverse outcome. If they'd come in under budget, then that would have been a favourable variance. So here we are. We can put a dollar figure on it. $6,000 percentage. Oh, just 30%. My maths is way off. And adverse. And that's important. An important point here. A variance is never positive or negative. It's always talked about in terms of being favourable or adverse. And that's what the IB Business and Management Examiner will be looking for. Never negative, never positive, never over, never under. We talk in terms of being favourable or adverse outcomes. And these things are so easy. Variance analysis, there's nothing to it. You don't even need a maths. You need about a 5-year-old level of maths. You just need to be able to punch numbers into a calculator, basically. Here we are. We've got a few departments here. We've got sales, raw materials, staffing, and we've got marketing department and rent. So these are all things that have been budgeted for. All you are required to do is fill in the gaps. So sales actually came in at $55,000 for whatever accounting period this is, perhaps for the month. And there was a budgeted value. They expected 50,000, or they budgeted for, I should say. Let's keep the terminology consistent. The organisation budgeted for 50k to come in. What's the variance? 5,000. Favourable? Yes. We sold more than we budgeted for, which is great. Raw materials, perhaps as a result of the higher sales, came in over budget. So the actual value of raw materials was 18,000 for this accounting period. We only budgeted 15,000. What's the variance? We know it's not good. We know it's an adverse outcome. 3,000. The maths is simple, right? You just punch numbers into a calculator. Here they're trying to trick you a little bit. They've given you the actual value. The variance has been calculated. We know it's adverse. We know that staffing is an expense. We know that more must have been spent on staffing than was budgeted for. 2,000 more. 21,000 plus 2,000 will give you 23,000. Marketing, we're just finding the numbers there again. Again, it was adverse. So the marketing department has overspent. They've overspent by $2,000. An adverse variance, 16,000. And look here, we've got a variance of 0. So whoever was budgeting the rent expenditure, bang on the money. 20,000 budgeted, 20,000 actually spent. Is a variance of nothing. And that's it. That's all there is to variance analysis. All there is to variance analysis. You don't need to know any limitations or benefits of variance analysis. Just a way to keep track of our actual budgeting figures compared to our actual figures. Nothing to it at all. 3 questions to finish off. Nothing too testing. I'm Mr. Burton. It's been a pleasure to have you with me today for this 3.4 budgeting section of the Accounts and Finance part of the IB Business and Management course. Hope to see you next time. 3.5 financial accounts or final accounts. A very, very, very probably the most important section of the Accounts and Finance topic. Lots to go into there, lots of detail, lots of different techniques and things to consider. I'll be looking forward to running you through that. Hope to see you there.